Hello, in this presentation we will continue with a comprehensive problem, that problem dealing with putting in the entries from a theory standpoint into an Excel worksheet and then putting those same entries into QuickBooks in an attempt to compare and contrast the two, show how everything gets put together similar to basically doing longhand, for example, in a calculator versus putting it into the QuickBooks and having the calculations be calculated for us. So that's going to be the idea of what we're going through here. We did two last time. If you weren't here last time, that's okay, because we're going to start from this point going forward. If you want to see what happened last time, then you can go through those instructional videos as well and take a look at those. So this time what we're going to do is move to the adjusting process. Again, if you missed the last two, that's okay. We're going to start from here forward, and you can just move from here forward. In this presentation, we're going to move to record and post adjusting entries. So we're going to post the adjusting process. We're going to enter adjusting entries to QuickBooks, and then we're going to learn to master Excel and Google Sheets as we go. So that's going to be one of our objectives as we go, would be to master Google Sheets and Excel and learn how to put those things together as we go. So we know that we have the normal rules for debits and credits when we're dealing with debits and credits, and those normal rules are going to be that we need to know how the board is set up, our board here being the T account, and we know that we have to line up the accounts or the account types on the board, assets being debit balance accounts, normal debit balances, liabilities having normal credit balances, equity, like the capital account or retained earnings, having a normal credit balance, and then income statement accounts, revenue having a normal credit balance, expenses having a normal debit balance. We're going to keep going back to this using a similar cheat sheet to this, the trial balance. Always recommend having a trial balance open, at least something like this open, or more preferably something like a trial balance open that can really help people out in remembering what the normal balances are. Once we know what the normal balances are, then we can basically apply the general rule, the simple rule of, if we want that balance to go up, we're going to do the same thing to it. If we want it to go down, we're going to do the opposite thing to it as what it is. Seems simple, can be complex. We'll keep on drilling this by doing it over and over again through examples and going through this thought process. In the adjusting process, you want to keep this kind of separate in your mind from the normal journal entries, because in the adjusting process, we're going to have a couple different set of rules that can basically help in that adjusting process. And those additional set of rules will be that all adjusting entries are going to be as of the end of the time period. The idea of the adjusting entries is that we want to make the accounts correct on an accrual basis. The adjusting process is going to be more than just the data input, and it's also one of those areas where people usually have problems. So it deals more with accrual basis accounting. So many times people run into some issues when we're just learning the data input, when we're just learning the QuickBooks side of things. We often run into problems with these adjusting entries. If we can understand the adjusting entries, then we have a better idea of what the accrual process is, why it is important. And I'm going to also point out when the adjusting entries are going to be, something we really need to do to have a good picture of the financial statements. And other times when small businesses, unless they're at the year end doing their tax preparation or preparing financial statements for a bank loan or something like that, may not be doing some of the adjusting entries. Why or why not? What are the pros and cons of the adjusting entries and the adjusting process? Okay, then we're going to say that the adjusting entries are not going to have something included in cash generally. The adjusting process is going to be something done oftentimes after the bank reconciliation has been done. And therefore, the cash account is actually going to be good most of the time in the adjusting process. So unlike normal entries, where we said like 75% of the time, we're dealing with one of the two accounts being cash, the adjustment process, we're generally not going to be dealing with cash at all. So we're not going to be asking that question we always asked before, is cash affected? It's not, because it's not a normal process entry. It's the adjusting process. Then we're going to say that one account is going to be a balance sheet account, the accounts above the capital account, above this blue line in this case, meaning assets or liabilities. One account's going to be an income statement account below this blue line, meaning revenue or expenses. And we know that income statement accounts only go one way, they go up. So income statement accounts, revenue has a credit balance, it's going to go up with a credit, and expenses have a debit balance, they're going to go up with a debit. If we can learn kind of these rules, then we can understand what to do in an adjusting process, meaning which way we're going to go. Are we going to debit the account or credit the account without really knowing what we're actually doing, which can be good just to do rogue process at first. Then, of course, we want to get a better understanding of why, what we're actually doing. That's how we'll go through this. We'll basically work out a system, say, hey, which account's going up, which account's going down, then ask the question of why, and how are we going to calculate that to get an understanding of it. We'll do that theory-based in Excel, and then we'll do it in QuickBooks as well. The information for those two things, Excel and QuickBooks, are in the link below during the presentation. So if you scroll down, you'll have a link, and that link will take you to download the Excel file. It will look something like this. And we'll also have a link to download the QuickBooks file. It's just a backup file, so you would need the QuickBooks software to run QuickBooks, but and I don't expect everyone to do that. It's okay if you don't have the QuickBooks, but just see that this same information could be in QuickBooks, could be in Excel. We're doing the same stuff here. Want to see how it ties out in Excel and then apply it to QuickBooks. We also have another link to a Google Sheets doc. So Excel is going to have a lot more detail in terms of what it can do to Google Sheets, but Google Sheets does everything we really need it to do right now. And when we're learning Excel, we really want to learn the fundamentals. So the fundamentals, adding and subtracting, what's the name of a cell, how do I move a cell around, that's really what you can get a handle on doing problems like this. So that's what we will work through as we go through this. This is going to be the QuickBooks file. The QuickBooks file just has some data that we put in before. We started off entering the data for the starting of the company and for 1 month of the company. And this is the trial balance we have here. You can see that the trial balance we have here is the same as the one we're going to start out on our Excel worksheet. The order is going to be a little bit different because notice we're not using account numbers. And the reason I'm not going to start off with account numbers is because a lot of small businesses don't use account numbers. I like account numbers, but it could be confusing at first because many people don't really understand the ordering of the account numbers, meaning we often feel like the account numbers are going to be the number one driving factor of the order of accounts. Just like if we don't have the account numbers, we might feel that it should be ordered in alphabetical order, but it's not. Even if we put account numbers in there, it's going to be ordered by the type of account, meaning assets, then liabilities, then equity accounts, then revenue and expenses. So beginners oftentimes when they put in account numbers have account numbers that don't make sense, meaning they're out of order because we applied account numbers out of order. So therefore, what QuickBooks is going to do is it's going to order these accounts first by account type, then by alphabetical order. And the drawback of that is that every time we put in a new account, it's going to go into either assets, liabilities, equity, income, or expense, but within those subcategories, it will be ordered by order of account. Also note that we don't have 0 entries here. All we have are entries that have actual things in them when we're dealing with QuickBooks. All right, so that's going to be the data we're going to work with, and we'll put it into Excel first, then we'll put it in here. We'll do one thing at a time and go through this piece by piece. So I'm going to check a few things, so I'll be back in just a second. Here's the first comic of the day. Okay, so let's see what we have. So we're going to put up the Excel sheet first. So here is our Excel sheet, and we're going to look at the adjusting entries. Now, what we have done so far, we've put all the entries in this tab over here. So if you open up the Excel sheet, it's going to have 2 tabs on your Excel sheet. Mine has more than that, but this is what we have entered prior to this time period for the month. This is the trial balance that has been generated from that data. this is where we're at as of the end of the month. These cells, this reference, you don't need to know this, but this reference is pulling these same numbers from this trial balance. So we call this an unadjusted trial balance. It's just a trial balance before we do the adjusting process. And the adjusting process might be done, oftentimes it could be done like at the end of the year by a CPA firm if it's a small company and you're working with a CPA firm, or it might be done in a different department, an adjusting process. And adjusting process often having a worksheet similar to this, meaning it's often done in some specialized software or software outside of the normal accounting system so that we can see these adjustments and we can document these adjustments. When we're in public accounting, we do similar types of adjustments and similar worksheets to make sure the financial statements are correct as of the specific point in time, the end of the year. So that's what we're doing here. We're saying, what do we need to do in order to make things correct as of the end of the year? One thing I want to point out before we do that is that most people, when they hear that, they think that that means that the accounting department did something incorrect. And that's not true. The accounting department did not necessarily do something incorrect. What happens is we set the system up in order to make sure that we're going to have these adjustments at the end of the process. Why? Because logistically it makes more sense. So when we go through these, think about how the adjustment works. Also note that they're not errors, and we'll think about why we would set a system up in which we would need to make these adjustments at the end. Why aren't we just running the accrual process all the times and therefore not needing to make an adjustment at the end of the month or the year? Okay, so let's see what we have. Where's our data? Data, first one, we're going to say as of 5/31, the date of the end of the month, the time we're going to put this information into the journal entry. We have prepaid insurance 12-month policy, $2,400. So what's happening here? 1 month has gone by, and we have an insurance policy for the entire year. So before we get into what we're going to do or why we're going to do it, I'm just going to try to figure out which two accounts will be affected. Now, remember we said that there's going to be one balance sheet account above the blue line, of the light blue line, and one income statement account below. If we have our trial balance, we can kind of look for those. We're going to say, we're dealing with something with insurance. How about prepaid insurance? I'm going to highlight that yellow and say that's the one we're going to deal with on the balance sheet side. What about on the income statement side? And again, we should have something related to insurance. It's not going to be tricky. We have prepaid insurance or insurance expense here. So we know that. We know those two accounts are going to be impacted even if we know nothing else. We know that income statement accounts, the dark blue accounts, they only go one way up. We know that expense accounts, they only go one way up in the expense direction. Are there exceptions to the rule? There will be. We'll talk about those later. But for the most part, we pay the insurance. The insurance doesn't pay us. It goes one way up. Expenses have debit balances. Therefore, how do we make something go up? We do the same thing to it, which in this case would be another debit. So we're going to debit that expense account. So we know that without even knowing kind of why we're going to do it. So I'm going to copy and paste this. I'm in cell G22. So rather than typing it into the journal entry, I'm going to copy this, right click, copy, and I'm going to paste it up here. I'm going to paste it in cell C5, and we're going to right click, paste it 1, 2, 3, just the values only. The date is going to be as of 5/31, and I'm not going to put an amount in yet. We'll think about that in a second. What I want to know is what's the other account going to be? If there's only two accounts that are going to be there, one's going to be insurance expense, the other is going to have to be prepaid insurance. If we debit the expense, we're going to have to credit prepaid insurance. So I'm going to go ahead and copy this, right click, copy, put it in C6, right click, and paste it 1, 2, 3. So without really even knowing what we're doing, except that we're doing an adjusting process and we're dealing with insurance, we can know which account's going to be debited and which account is going to be credited. Now we just need to know the numbers and why. Why is this happening? So if we think about what happened here, we're going to say, okay, prepaid insurance has $2,400 in it. Why is it up there in an asset in the first place and not as an expense? Because we told the accounting department, hey, whenever you pay the bill for the insurance, you put it into prepaid insurance. Why? Because prepaid insurance, by definition, is something we pay for before we use it. So this is one of those things. We're setting the system up in such a way that the bill can just be paid and always just go to the prepaid account. That's logistically easy to do. And then at the end of the month, we are going to then adjust it so that the financial statements are correct as of the cutoff date, as of the date we make the financial statements. So we're saying, okay, accounting department, you just write the check and it'll go into the prepaid insurance. Now it's the end of the month. We need to make the financial statements. We need to see how much of that policy has now been consumed. How would we do that? I'm going to do this with a formula, or let's do it with a calculator first. We'll say that we had a policy of $2,400 for 12 months. So if we divide by 12, that's $200 a month. 1 month has now passed. Therefore, we've consumed $200. I'm going to do that same formula here. We're saying this equals 2400 divided by 12 means that we have $200 that has been consumed. We're going to have the credit, the same thing, credit of $200. Now let's post this out. Let's see if it does what we believe it should do. So we're going to say, I'm going to post the prepaid insurance first. So here's prepaid insurance. First of all, is it an asset, liability, equity, or expense account? It's green and it's up in with all the other assets. So it's going to be an asset account. And if we credit it, we're doing the opposite thing to it as what it is, a debit asset account. Therefore, it's going to make it go down. We're going to show that in column I. This will be our adjustments. So in column I9, we're going to say this equals and post to this credit. This is debit, that's a credit. That 2,400 is going to go down 2,200. Does that make sense? Well, we had a policy of $200 a month we just figured out, and there's 11 months remaining. So we would say that should be $2,200 that is still prepaid. That seems to work out. Let's post the other side. So we're down here on prepaid insurance. I'm going to post it with formulas. Notice we're out of balance down here. Equals, and we're going to scroll up, and I'm going to point to that 200. Scroll down. What's going to happen? It's going to go from 0 up by 200 to 200. We're back in balance. Debits equal the credits. Debits equal the credits. Debits minus the credits equal 0. What happened to our net income? Well, expenses went up. Net income went down, meaning this credit balance is going down, right? So it went down by the 200 to the 5,460. So we can do the same information in QuickBooks. Now, QuickBooks normally tries to stay away from journal entries, but this is the one problem where we can't really stay away from journal entries. Even in QuickBooks, we typically will use journal entries. So we're going to go to the company file, and we're going to make journal entries. And we're just going to put this same journal entry in here, and we're going to put the date as of the end of the month, 5/31. Make it 1/7 in this case. And we're going to call it insurance expense. And we don't have that yet because we told the accounting department to always put their bill to prepaid insurance. So we haven't yet set up an insurance expense account. So we're going to tab, I'm going to set it up, and I'm going to make it an expense type of account. And there it is. Same thing here, expense type of account. It will be for 200, tab, 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 tab. Then the credit is going to be prepaid insurance, what we have already set up. This is where the accounting department is writing the checks. Every time they write a check, this account probably just automatically populates, so we can just put the data input there really quickly. And we're going to say save it and close, see if it does what we think it should do. So I'm going to say okay. And there it is here. So I'm not sure if I refreshed that. I sold it not to refresh it. That wasn't good. Trial balance. Refresh. I gotta change that option. All right, so there we have that. We're gonna say prepaid insurance and insurance expense 200 on the insurance expense. Prepaid insurance is now 2,200. Same idea in both aspects. Notice in QuickBooks, we can't really see the links, however. In the adjusting process, if we use a nice little worksheet like this, we can say, here's where we started, there's where we ended, and we can see how everything ties together. That's one of the benefits of using a sheet like this. I'm going to get rid of these yellow items, and we'll do the second adjusting entry, same way, same form. We're first going to figure out which accounts are going to be affected, and then talk about why. Okay, so the next one is going to be Let's see, I'm gonna make this one green. That one is done. Make it green and see what we have next. They're all on 5/31, the end of the month. Supplies on hand at 5/31 is 800. All right, before we even talk about what that means, why we're saying that, let's think about which two accounts are gonna happen, which two accounts are gonna be affected. One will be above the equity balance sheet account related to supplies. How about supplies? So we're going to say that supplies is going to be one account. One account will be below on the income statement related to supplies. Again, how about supplies expense? Supplies expense. Those are going to be the two accounts that we're going to be dealing with at this point. And we know that the expense accounts, income statement accounts, only go one way this time. Expenses going up. Expenses have debit balances. Therefore, we're going to make it go up by doing the same thing to it, which in this case will be a debit. So we know that we're going to debit the expense account, even though we might not know why. So I'm going to copy that, and we're going to put that up top. I'm going to paste it in C8, right-click, pasting it 1, 2, 3, just the values only. If we debit the expense, that means we must be crediting this supplies being an asset indicated by that's next to all the other assets, and it's green. So I'm going to say that must be the credit. Let's copy that and paste it in C9. C9, it's right there. Right click and paste it 1, 2, 3. All right. So again, we know what the debit is. We know what the credit is just by knowing that we are doing an adjusting process and by applying these rules of the adjusting process. Now let's talk about why. Why is this happening? Why are we doing that? And we're going to say supplies is 800. So how did we logistically set up the supplies process, and why does that make sense? Just like we did with the prepaid insurance, whenever the purchasing department buys supplies, we're going to tell the purchasing department always debit supplies the asset, not supplies the expense. Why? Because it's easier to do that way. And then at the end of the time period, we're going to go in and we're going to adjust it. How? By doing a physical count, seeing how much has been consumed, and then making the adjustment. Now, this does not apply if we're talking about paper clips or something like that, very small. But if we're talking about fairly large items like ink or paper, we're going to do a similar process that we would for inventory. And if we just tell the supplies department in a periodic inventory type system to purchase the supplies, put it into the supplies account, then we're going to count it at the end of each month, figure out how much is left, make the adjustment at the end of the month. That logistically is a good way to do it, to make the financial statements correct and make the data input during the month as easy as possible. So that's what we're going to do. We basically had a physical count and said, okay, there's 800 left. And if we say that's what we need to make the supplies account be. So at this point, there's 1,200 in the supplies asset account. We need to make it 800. Therefore, what are we going to do? We're going to subtract those two. We're going to say that we need to take the 800. I'm sorry, not the 800. We need to take the supplies 1200 minus 800. And that should give us 400 that we need to reduce. So the 1,200 reduced by the 400 will bring us to the physical count, the 800. There's one minor detail here that the 800 obviously isn't a physical count in units, that's dollars. So when we count the units, we're gonna have to say, here's how many units we have, convert it to dollars. Just like kind of any kind of conversion, which is kind of, could be a bit of an issue. We'll deal with that later. But in essence, we're saying we have $800 worth due to a physical count, meaning we got to take the 1,200 down by 400 to get to that count of 800. All right, so let's do that, 400. So we're going to say 400. I won't do the formula again. Credit of 400. So now we're going to put the numbers in. We'll put them in place, see if it does what we expected it to do. What did we expect it to do? That supplies here should go down to 800. So let's see that first. We're going to put the credit here. I'm in cell I7 equals, and we are going to point to this supplies. So we've got this debit, and that's a credit. Those are opposites. If we hit enter, this is going to go down to the 800. That looks correct. Now we'll do the other side. We're going to do the expense side. I'm going to scroll down. Here is supplies. Where is it? Supplies expense. And we're going to say equals. I'm in I20. I20. Say that equals. I think I must have hit a Oh, there it goes. So, all right, 400. All right, so now this is what happened here then. We had the expense go up, brings net income down, meaning the income, net income is the credit 7,400 minus the expenses. And the expenses went up. So this is not a negative number, meaning it's not a loss. It's a negative number, meaning credit on this worksheet. I know that's something we just got to get used to with the worksheet, but it is a very useful tool to have in that way. Okay, so that's going to be that. We're going to do the same thing now in QuickBooks. Let's go to QuickBooks. All we can do is just do it by a journal entry. So this is some place where QuickBooks cannot really avoid the journal entry. So we're going to go to Company, make journal entries as of the end of the time period, 5/31. That's the date we're making the financial statements. The accounts will be supplies, expense. And we have to set up the new account, and my computer's going slow here. We have to set up the new account because we don't have the supplies expense set up. We told the accounting department to put it into supplies, the asset. So we're going to say supplies is an expense account, and it's an expense account, and we're going to put the 400, and then the other account was supplies. Just put in the same transaction in, and we're going to save it, and I'll say save and new this time. Then if we go to the trial balance and check it out, we can say that the supplies went to 800. That looks like the same thing there. And then we had the supplies expense 400. If we check the other reports, profit and loss now, we can see is at 5,060. And if we look at our profit and loss, we just did the quick calculation of the trial balance given by the fact that we have debits as positive and credits as negative of that same 5,060. All right, next one, let's say 531. Let's get rid of the yellows. And notice you can't put yellows if you're working through this problem here because I locked some of the cells just so you didn't accidentally delete some formulas. So I'm trying to help you out by doing that, not to cause any problems from that. But you can only enter data in the blue areas so that you don't try to get rid of or delete formulas that could not be good. All right, so now we will look at the next one. I'm going to say this one is done. I'm going to make it green, indicating that it has been done, and move to the next one. All right, now we're on depreciation. Equipment, it's 5-year property. Cost of equipment was $18,000. Okay, so again, before we even talk about what depreciation is, let's just see if we can figure out what the debit and the credit related to depreciation will be. It's an adjusting entry, so there's going to be one account in the balance sheet area above the blue line related to depreciation. How about accumulated depreciation? Sounds like it could be applicable, so I'm going to say that's going to be one of the accounts. I'm just going to make it yellow. That's what I'm doing here, making it yellow. And then there's going to be an account below the line in the income statement related to depreciation. How about depreciation expense? Seems reasonable. And so we will take that. I'm going to make that yellow. All right, now the expense accounts, all expense accounts have debit balances. They only go one way, they go up. So we're going to take this debit and we are going to increase it. So we're going to do the same thing to it, which in this case will be another debit. So I'm going to copy that, right-clicking on G21, copy, put our cursor on C11, right-click and paste it 1, 2, 3. The amount, I'm not going to put the amount in yet. What's the credit going to be? It's going to be the other account. If we debited the depreciation expense, we're going to credit accumulated depreciation in G11. I'm going to right-click that because I really don't want to spell that one out, and paste it 1, 2, 3. All right, and notice that if we wanted to make this look nicer with an indentation, we could go put our cursor on all the credits, go to the Home tab, Alignment, Increase Indent. Next one, Home tab, Alignment Group, Increase Indent. Next one, Home tab, Alignment Group, Increase Indent. All right, now let's talk about what we're doing, why we're doing it, what's going to be the number that we're going to need to use. So we're going to say, let's see, depreciation. So depreciation is related to the equipment, indicated by the fact that we're talking about the equipment here. Now, when we look at a real financial statements, we might have multiple pieces of equipment, and the depreciation schedule therefore will be quite complex. But the concept is pretty straightforward, meaning that when, just like everything else logistically that we've been looking at, logistically we told the purchasing department or the accounting department, when you buy equipment, you're going to debit property, plant, and equipment, not equipment expense, not tools expense. Then in the adjusting process, at the end of the year or the month, we are going to go in and adjust that. That just makes sense, or it's an easy format to do. And so that means that they put the equipment on the books at $18,000. We then are going to reduce the value of that in accordance with the life of the equipment. And so it's a 5-year equipment. 18,000, so we're going to say 18 divided by 5 would be, it should go down in value. If it was straight line, we'll talk about other methods later, but straight line's the baseline method of 3,600, but that's for a year, and we're only talking about a month. So I'm going to go ahead and divide that by 12 and say it's going to go down 300. So 300 is going to be the number that we will use. But note that we're not putting it to equipment expense. It's going to depreciation expense, and that's slightly different. Why is it going to depreciation expense, not equipment expense? There's a couple reasons. Notice the supplies, we did a similar activity here, but the supplies we said was related to a physical count, meaning we can physically see the deterioration in supplies. However, equipment doesn't physically go down. If we have one forklift, we still have one forklift. It's just that the value has gone down. Therefore, if we create another account, our first contra asset accounts having debit balances, contra meaning it will have a credit balance, is going to be this accumulated depreciation. Why do we have it? To show our reader a couple things. One, hey reader, here's the cost of the equipment, and here's the estimate of the reduction in value. If you want to know what we think the book value is, you'll have to subtract the two. And that gives our reader a little bit more information about this item, an important item, because it's a big ticket item. All right, let's recalculate that same number one more time. I'm in D11 equals, we're going to put the cost, 18,000 divided by 12 months. I'm just going to divide it again by, divided by 5 years, divided by 12. And you could just put the 300 in there, but I'm just showing you how to put the formula in. Notice that it's almost easier to do that particular calculation in a calculator than in an Excel, or at least do it first in a calculator. But in any case, the debit and the credit will be 300. Let's post that out, see if it does what we believe it should do. So I'm in I11. I'm going to say that equals, and point to the credit, and it goes up in the credit direction. The contra asset account goes up in the credit direction, bringing down total assets, bringing down the book value now being 18,000 minus 300, or 17,700. Then we'll post the other side, which is going to be down here in I21 equals, we're going to point to the depreciation expense going from 0 up to 300, back in balance by the green zeros here, and net income has gone down. Expenses went up, brings net income down, net income being the credit minus all the debits. Let's do the same thing in QuickBooks. So we'll go over to QuickBooks here. We're going to go to, I left it open this time. I was smart and left it open that time. That's good. So we're going to say 531. And we're going to say that we have depreciation. I'm going to type it in there real slow. All right. And it's a new account. Again, we don't have this yet. This is the first time we have recorded depreciation expense because this is an adjusting entry, and these are our first adjustments. So we're going to say 300. It's an expense type account. The credit will be to accum. This is going to be, oh, they have that already. So the system put that in there, I think. Okay, so there's our credit. So that's good. I didn't have to type that in, so I'm happy about that. So I'm going to say save and new. And there we have that. Let's see if it looks like what we have been doing on the Excel side of things. We have, let's see. accumulated depreciation there. Now, if you're like me, it might be very kind of annoying to you that the accumulated depreciation is above the depreciation, the furniture and a fixture. And again, the reason that's happening is because both of those are in what QuickBooks sees as the furniture and fixture area, and it's in alphabetical order, and that's why they did that. In order to fix that, we would basically need account numbers so that we can have this one traditionally goes before this one. But anyways, so then we got the depreciation expense is going to be here. If we look at the profit and loss, then we see 4,760. Is that what we calculated over here? 4,760 is the same. So that looks good. That's a good indication that we have done things correctly so far. All right, next one. I'm going to say this one. I'm going to get rid of the yellow. We're going to do on B14, another 531. And we are going to have, let's see. I'm going to make this one green. That one has been completed. All right. Accrued wages, 5-day work week, weekend, and pay on Friday. That's what it's going to say if I have the extended cell here. Let's bring that down again. Friday. Month ends on Wednesday. Okay, so before we get into what that means, what we're trying to say there, we're going to just figure out which two accounts are going to be impacted by this. So we're talking about wages or salary, something to do with payroll. So if we take a look at our rules, we're going to say here are the accounts above the blue line, the balance sheet accounts, which ones are going to be have to do with salary or payroll. How about, let's see, what do we have here? Prepaid insurance. How about salaries payable? Seems reasonable. It looks like a liability account. It's next to accounts payable in the liability section. How about on the income statement? We're going to say that's something to do with salary or wages, and we got salaries expense. We also know that these are expenses, and they only go one way, up. Expenses going up in the debit direction. So how are we going to make this go up? We're going to do the same thing to it, which in this case is another debit. So I know if we're going to do something with this one, we're going to debit it, even if we don't know why. So I'm going to copy that, going to paste it 1, 2, 3, C14. And if we debit that and there's only two accounts, then this one will be credited. So G13, right click, copy, gonna paste it in C15, right click, pasting it 1, 2, 3. So we can know all that without knowing why. So that just by knowing those rules. So now we're gonna talk why. Why are we doing this? So I'm gonna go to our data here and we're gonna say, we have a 5-day work week. So this is going to be a simplified work week. We shook hands with our employee and we said, we're going to pay you every Friday for 5 days worth of work. Therefore, as of the end of the month, we need to determine whether or not it landed on Friday or not. Why is that important? Well, logistically, again, if we're just going to say we're going to pay the employee every Friday, we're not going to deal with an accrual basis. I'm not going to accrue every hour they work and say, hey, we owe you an hour's worth of work. It makes a lot more sense for us to tell the payroll in our accounting department, hey, just be on a cash basis with this particular thing. When you pay, when you write the check on Friday, that's when you record the debit to wages expense and the credit to wages payable or cash. Then when we go in and we see, oh, there's some wages that are still owed, then we'll make that adjustment. Why would that be? Because Friday will almost never land on the end of the month. The Friday's not going to land on the 31st. In this case, we're saying it landed on Wednesday. So what does that mean? It means this employees worked Monday, Tuesday, and Wednesday, and they haven't gotten paid yet because they're not going to get paid till next month. So if we make the financial statements as of the end of the time period, we're going to have to record the fact that we owe our employees this amount, a liability, and that they have earned it. We've used their services and consumed an expense in that case, recording the expense and the related liability at this time period. This is one of those entries that a small business might not do as often if they're not trying to get a loan or something like that, because it's one of those entries at the end of the month that's a timing difference. But on an accrual basis, it could be very significant. If you get a loan or something and the bank wants an accrual basis, it could be very significant to accrue the payroll that is owed as of the date that the financial statements were generated. So that's what we're going to do. And so we're going to say that accrual wages, and we're just going to give the amount in this case, which was $960. Let's see, accrued wages, 5-day work week, weekend pay day on Friday, month ends lands on Wednesday. So I think what we're saying is this times, we're going to say that this 960, we're going to say that that's for the end of the week, which we're not going to pay, or we did pay after the month end. So I'm going to say 960, that's for a 5-day work week, divided by 5. That's going to be 192 a week. And then if they worked Monday, Tuesday, and Wednesday times 3, that's going to give us 576. So I'm going to say it this way. We're going to say this equals the 960 divided by 5 times 3 days. And that'll give us the 576. All right. That's going to be the debit. And if we debit that, then of course we're going to credit the same amount, 576. And we can record this out, see if it does what we think it should do. We could indent this. I go to the Home tab, Alignment, Increase, Indent. And we then go to Salaries Payable. That's in I-13 equals, point to that credit. And that's going to make the liability go up in the credit direction. So that's not going in the hole, it's going up in the credit direction. Then we're going to go to the Salaries Expense. And Salaries Expense, and we're going to say that that equals, and we're going to point to the 576. And that's going to increase the expense to 1,536, bringing net income down to 4,184, that being calculated as revenue minus expenses. All right, so now let's see if that did what if we can put that same information into QuickBooks. So we're going to say the journal entries, and we're going to say as of 5/31, they're all as of 5/31. We have salaries expense. We've already recorded salaries expense, so it's popping up automatically for the amount we said of 576. And then we've got salaries payable. That's going to be a new account. Tab. We're going to have to set that account up. What should it be? It's going to be a liability. So I'm going to put it down here in other current liabilities. Continue. Same information here. And save it. All right, so now we're going to save and new. And let's see if it did what we should do. We're going to say that we have the wages payable. That's accounts payable. Where did the wages payable go? Salaries expense. So now I'm going to drill down on this. Not sure that recorded. Oh, here we go. So it didn't record. So this is 576. I didn't put the other side there. That's a problem. And save and new. There we go. Trial balance. And there it is. All right. So there's that. There's the salary 1536. Is that what we have here? 1536, and net income 4184. So let's check that. We're going to go to profit and loss. We're going to say 4184. All right, so everything looks okay. So we're going to go back here, and I'm going to unyellow these. We're going to say that's going to be unyellowed. And next one, 531, as they all are as of the end of the month. That's what the adjusted entries do. And we're going to go back to our data. I'm going to make that green. We have completed that. and see what the next one looks like. Prepaid rent as of 5/31. All right, so now we're going to do a similar process. Again, I'm not going to go through why we're doing this, prepaid rent, what it should be, but we're just going to see this is an adjusting process, which two accounts will be affected. One's going to be a balance sheet account above the line here. We'll have a balance sheet account related to something to do with rent. How about prepaid rent? We're going to say that's going to be one of the accounts that we will be dealing with, prepaid rent. One of the accounts below the line in the income statement having to do with rent in some way. How about rent expense? We know that income statement accounts, including expense accounts, only go one way, up. These are debit balance accounts. We're going to make them go up by doing the same thing to them, which in this case would be another debit. So I'm going to say that this is going to be a debit, G19, copy that expense, put it up top in C17, right-click, paste it, 1, 2, 3. Then we're going to do the same. That means that the other account, prepaid rent, will have to be the credit. So I'm going to copy prepaid rent, put it on the credit side in C18, right click, paste it, 1, 2, 3, and then I'll go out of the home tab, alignment, and increase the indenting. Okay, so I'm going to check something real quick and we'll see our next comic of the day. It doesn't want to go to the next comic of the day. Do this. There we go. All right, so let's see what we have here. Okay, so now we've got the debits and credits. Again, we can do all that just by knowing it's the adjusting process and just knowing the rules for the adjusting process without even knowing why we're doing what we're doing. Now let's talk about why we're doing what we're doing. And we have prepaid rent. So we're going to adjust the prepaid rent account. And in order to do that, we're going to say that we're going to need to know what's still in prepaid rent, in this case being $10,000. What is prepaid rent? How did it get there? So again, logistically, if the bookkeeper purchases rent or pays for the rent, so the rent of the facilities, they could either debit the expense, rent expense, or debit prepaid rent and then credit cash when they pay it. Now, if we're just paying monthly, the easy thing to do is set the system up so that every time they pay, it's just going to debit the expense account. But if we typically pay in advance, or if we have a one-time case where we pay in advance, for example, if we paid the entire year's worth of rent, then we would want to first put that information into a prepaid account for a similar reason as we did with the insurance. So we're first going to put it into the prepaid account and then expense it. And so we're going to tell the bookkeeper, just put it into the prepaid. We'll make the adjustment basically at the end. That will be the simplest way to deal with this. So in order to do that, we have to determine, we're not going to get into how it was determined in this case, but we determined that the prepaid rent should still be $10,000. We have prepaid rent on the books. Let's see, prepaid rent of $12,000. So we need to bring that down to $10,000. That's what we determined it should be. So we're going to say, okay, there's $12,000 there. We need to say minus 10. That means we need to bring it down $2,000. So that $12,000 minus the $2,000 will bring it to what we determined it should be, $10,000. So let's do that again. The formula over here is going to be equal to 12,000 minus 10,000, enter, and that will give us the 2,000. That's what we're going to bring it down to. That will be the debit, and that will be the credit of the same 2,000. Let's post this out, see if it does what we believe it should do, meaning it should bring that 12,000 down to 10,000, the amount we determined it to be. So in I8 equals, and we're going to point to prepaid rent, the credit, bringing that debit down with a credit to 10,000. Then we're going to go to the rent expense. So we'll go down here to rent expense. And in I-19 equals, we're going to point to this 2,000. That'll bring the 0 up by 2,000 to 2,000, put us back in balance, and it'll bring net income down. So there we have it. So we have the expense went up, brings net income down. Let's put that same information into QuickBooks. All right, QuickBooks, we got the make a journal entry, and we're going to say same thing here. We're just going to have to put it in as a journal entry. We're going to say rent expense. We don't have it yet because all we did was do a prepaid rent. So we're going to tab, we're going to set it up. It will be an expense, so expense. It's going to be the same information, expense, and it will be for 2,000. We will also have a credit of prepaid rent. Make sure you get the rent and not the insurance. And that'll be for the same amount. Save and new. Let's see if it does what we think it should. It should connect just like we're doing in our worksheet. It should connect everything together. If we go to the trial balance, we're going to say, prepaid rent is now at 10,000. That's what we determined that it should be. And we can see that the rent expense, 2,000, that looks the same. That looks correct. That looks like we could move to the next and final one, and we have to stop after this one because that's our last one. So that's we'll have to really enjoy this last one. So we're going to say this is also as of 5/31, as are all of the adjusting entries. I'm going to make this green, saying that we have completed that. And next one's going to be related to unearned income. Again, we might not even know what unearned income is, but we are going to look at our accounts and see if we can figure out what the two accounts will be. One's going to be a balance sheet account above this blue line, an asset or liability account, and it's going to have to do with income or unearned income. And how about unearned income? So that one, unearned income here, we might not know what that is, but we can see if we have the trial balance that it's next to the liabilities. It's orange in this case, which means it will be a liability. So we know it's a liability. What's going to be the income statement account related to unearned income? A little bit more difficult, but we're going to say it's going to be revenue or income or revenue and unearned income. So those are going to be the two accounts. We also know that income or revenue is an income statement account, and all income statement accounts only go one way, for the most part, up. And this has a credit balance represented by the fact that it has brackets. How do we make something go up? We do the same thing to it, which in this case is a credit because it's a credit balance. So we're going to credit it to do the same thing to it, making it go up. So I'm going to copy the income and we're going to put it on the bottom because credits traditionally go on the bottom in C21, right click, paste 1, 2, 3. Note this one's a little bit backwards than what we've done before because most of the accounts we adjust when we deal with timing differences will be where there's more accounts in terms of the income statement, expense type accounts. And this one, of course, has to do with the revenue type account, and therefore the revenue is going to go up with this one. We can go ahead and indent that as we go. Go ahead and home tab, alignment, and indent. That means that this must be the other account. That must then be the debit. So I'm going to say copy. We're going to put the unearned revenue, this unearned revenue account. Should probably name the account, but we'll put that on top. And we know the debit and the credit, therefore, just by going through these set of rules, even if we have no idea what unearned income or unearned revenue is, and now let's figure out what it is and see why we're doing this. Okay, so unearned income as of 5/31. The reason unearned income is more unusual to most people is because not all companies will have unearned income. It's going to be kind of industry specific in many ways, but it's a really good test of what the revenue recognition principle is and what the accrual principles are. So what unearned revenue means is we got paid before we did the work. Now, typically, we probably think of it the other way around, meaning if we do a service company, if we do bookkeeping, we often do the bookkeeping or the taxes before we get paid, meaning we didn't get the money, but we did the work. We earned the revenue, we didn't get the money. This one is reversed. We got paid, but we didn't do the work. When does that happen? Well, you can think of it like if you have a rent, the security deposit is kind of a form of unearned revenue, meaning you paid the first month rent, the people that received the money got income, but they didn't earn that income because you haven't lived in the facility for the last month, or the secure deposit hasn't been consumed. You'll probably never get it back, but it's technically not been there yet, so therefore it shouldn't be revenue. If you have a concert or something like that, clearly you got to sell the tickets before you have the concert. If you sell tickets before the concert, it hasn't been earned. Therefore, it really shouldn't be revenue until the point in time that the concert happens. Another businesses, of course, a lot of businesses are subscription related. So if you're buying a subscription of some kind, like a magazine subscription or any other type of services, a lot of the software and stuff is month-to-month type subscription things. If you're buying a year's worth subscription to a particular software or something like that, those are industries where the payment happens before the service happens. So that's why the unearned revenue happens. It's on the books because in that particular industry, we got money before we did the work. If that's the case, if we sell newspapers, we get money before we do the work. Again, logistically, we're going to tell our accounting department, hey, whenever you get money from a client, just debit the cash account, and the other account's just going to go to unearned income. Just put it into unearned income, and then at the end of the month, we're going to figure out how much of it has been earned, and that's just how we're going to set the system up, because it's an easy way to set the system up. So at the end of the time period, we determined after our calculation that we're not going to get into now, that the amount that is still unearned, meaning the amount of newspaper subscriptions in the future that we got paid for that we have not yet sent out or broken any windows with those papers, is 3,000. So that means we got to get this number, 4,500, down to 3,000. So 4,500 minus 3,000 means that we need to take this 4,500 down by 1,005 to get us to 3,000 that we determined it should be. All right, and we don't need to know the debits and credits because we already figured that out. So, but once we post it, we want to think about it. We already know that we're going to have the 1,500. Oh, what happened there? It's going to be a debit here to unearned income. Man, 1,500. All right, and it's going to be a credit here. We already know that because we figured it out before, but let's put it together and see if it does what we think it should do. Does it make sense? We're going to post this one out first. I'll post the unearned income in I-14 equals, pointing to this 1,500. That's a credit. That's a debit. Those are opposites, making this account go down to what we wanted it to go to, 3,000. Then we're going to do the same thing for the revenue. So revenue is in I-17 equals, we're going to point to this 1,500. This is a credit. That's a credit. Those are the same things. It's going to make revenue go up. Also going to make this go back in balance and make income, net income, go up. So there we have that. And this one's increasing the net income. All right, let's post this last one to the QuickBooks as well and see if everything ties out as we hope that it should. And we're going to say that we have a debit to unearned fees, which we already have because we've been recording that. And the amount will be, what did we determine? 1,500. So 1,500 debit. We're going to credit revenue or income for that same 1,500. Save and new. Trial balance, unearned fees now at 3,000, and our income now at 8,009. Unearned fees over here was at 3,000 and income 8,900. Let's check the net income just to round things out. 3,684, and we go to the net income over here is going to be the 3,684. So that basically, that's going to be the adjusting process. Now, again, when I look at small businesses, a lot of times they kind of worry about the adjusting process because this is a process that does take a knowledge of debits and credits in order to do. The data entry, just putting in the data and setting up the system in order for the data entry to be automated, can be set up, especially if you have a well-designed system, so that the data can be just, put in place and the accounts hit what the accounts should hit, and then set up a system where basically we can do the adjusting entries at the end of the month or the end of the year, making the accounts correct as an accrual basis as of that time. Small businesses can do that with a CPA firm or have someone to help them out with that adjustment process. And again, if we're small businesses that aren't looking for financial statements for a bank or something like that, some of these entries may be things that they're not doing. Some of them are things that they should have a good idea of. For example, depreciation is something that you probably want on your financial statements in order to make good decision-making processes. Something like the salaries expense every month might not be as useful to a small business because it might not be adding the value to help them make decisions and costing more in terms of time versus the value in terms of decision making. But if you need it to make the financial statements as of the end of the year, either for taxes and or for getting a loan or something like that, the books will have to be most likely put on a accrual basis, more specifically, and have these adjusting entries put in place. So those are going to be the adjusting entries. QuickBooks is an area where you still just have to do the debits and credits for the most part. There are some ways you can kind of work around it, but they're just as confusing as doing the debits and credits. Okay, so next time what we're going to do is we're going to take this adjusted trial balance and we're going to put that and make the financial statements with it. And you'll note that that QuickBooks has been doing that the entire time here. We've been looking at the financial statements. That's going to be the profit and loss and the balance sheet as we go. But again, QuickBooks just kind of pops it on the screen and we might not know how it's working. And just like we are doing with a calculator here, if we said, 5,000 or, times 21, we'd have, the calculator will do that, but we need to have some understanding of what it's doing. And so what we're going to do is basically next time in Excel, work through this adjusted trial balance to make the financial statements, the balance sheet, the income statement, the statement of equity, as has been generated from QuickBooks as we go, to get an understanding of how this trial balance is the same thing as basically the balance sheet and the income statement, how it has to work. If this thing's in balance, this thing has to be in balance. By doing that, I don't expect everybody obviously to be generating financial statements by hand all the time, just like I don't expect anyone to do manual multiplication of complex problems by hand. But we do need to want to understand how they're put together. That way it'll help us to interpret how to do the data input and what the data input is doing, and therefore help us to make decisions with what the output is from QuickBooks from the data that we put in. Then next time we're going to do the closing process and talk about how QuickBooks does the closing process and the kind of the pros and cons of the general quick setup of QuickBooks in the closing process. You don't have these two tabs in the current worksheet. They'll be included in the next worksheet. If you haven't done these steps for the next worksheet, you can just go to the next worksheet forward without these steps. We're going to do the same thing, starting with a worksheet that could start from here forward. But if you want to go through these, that's good too. There's going to be some, hopefully, if these worked, there'll be some instructional videos on those to look through what has been done in the past.